Citadel made $16 billion in a down market. It blows my mind that more people don't know about this. And the more I looked, the more ways I found. But there are tons of ways to try and make money in a bear market. Like a lot, but most investors just bury their heads in the sand and wait until it's over. And that makes sense because historically the market does go up more than it goes down. And it is technically harder to make money in a down market than the other way around. But that didn't stop Citadel from making $16 billion in 2022, the largest ever profit by a hedge fund, even though the market fell 18% that entire year. If you break it down, their biggest profit was from Q2 to Q3, and if you look at what they were holding in Q3, it's a bunch of straddle options against the S&P 500, the Nasdaq, Tesla, Nvidia, and other companies. A long straddle pays off when volatility increases and the price of the underlying moves by a large amount, but it doesn't matter if it's to the upside or the downside. Here they made $14 billion on the Nasdaq, they made $2 billion on the S&P 500. So here are ways to hedge your portfolio or try to make a profit in the down market. 1. Investing in defensive stocks. Defensive stocks are less sensitive to economic downturns and tend to outperform the broader market during bear markets. They're usually well-established companies in the consumer staples, utilities, and healthcare industries. For example, you can see right now, Eli Lilly is doing really well. So is Walmart. Number 2, buying an inverse ETF. Inverse ETFs just do the opposite of what their counterpart ETF is doing. For example, the SPXX is an ETF that moves in the opposite direction of the S&P 500, but 3 times faster. So if the S&P 500 fell 0.32% today, it's supposed to move 3 times more in the opposite direction. These are not perfect, by the way. This should be 96, but it's 1.07. Inverse ETFs are not meant for long-term investing and usually recommended to be held for 1 day or less because they go down a lot more than they go up. There's the same thing on the Nasdaq, the Russell, and tons of other ETFs. 3. The VIX hedging strategy. A lot of traders, especially on X, Twitter, love this. The VIX is often referred to as the fear index and is a market measure of future volatility. It increases in times of uncertainty. So if the VIX is high, it means that there's a lot of fear and uncertainty in the market. So if you bought the VIX right before a market crash, you'd benefit from the fear and increase in volatility. You can buy the VIX itself or VIX ETNs, which are a bit more liquid, like the VXX. Number 4, short selling stocks and ETFs. This is the classic way to short the market. It's kind of complicated how it actually works, but basically you just sell the stock at a high price and hopefully buy it back at a lower price. When you buy it back, you profit the difference between the price that you sold it first at. It's the opposite of buying a stock, so you profit when the stock goes down. You can short sell individual stocks that you think will go down, or you can bet on the general direction of the market by short selling the Nasdaq or the S&P 500. But beware, because selling stock is risky and your losses can be unlimited. The more the stock goes up, the more you can lose. Short selling has to happen on margin, so you could lose a lot of money that you didn't have in your account if you short a stock that starts rallying like crazy. That's what causes hedge funds to get short squeezed. They have a bunch of short positions, but a stock starts rallying. 5. Buying or selling options. Options are very complicated and there are a lot more variables than there are to simply buying or selling a stock. They're typically used for hedging and protecting a profit. For example, the value of a put option or a put spread might increase when volatility is low and a security against it falls. If volatility is high, you could do the same thing by selling a call or selling a call spread. Something original I found about recently is buying a put on the VIX after it spikes. The VIX is naturally going to go down after a volatility spike, so you'd profit off of it going down. That being said, it could be super risky because you could think that it spiked and then it spikes even more. There are tons of different advanced option trading strategies like straddles, strangles, calendars that can help you benefit from a rise in volatility. However, options are extremely risky as your investment can drop to zero almost instantly. Your losses can also be unlimited in a lot of cases, so it's important to proceed with caution. Like and follow for more videos like this.